Hello, options traders. Welcome, everyone. I wanted to talk a little bit what I think is probably one of the most important concepts in all of options trading, because options are so versatile and we can break them apart, we can add to them, we can do a lot of different things that we simply can't do with stock. But I find that so many traders miss this part of the trading equation. So let's take a look at what I'm referring to here and show you how you can become better by understanding that your entire position can be viewed as a series of parts. And if any of those parts become fully valued, it makes no sense to continue holding them. Instead, you should sell them off. So again, the trading concept I think you need to understand is that your entire position can be viewed as several pieces or several components. And it doesn't matter how simple or complex the strategy may be, this always applies. Now, it becomes a lot more applicable for the more complex strategies and things where you have multiple strikes, like a butterfly or condors or even vertical spreads. But it does apply to everything. So the thing to understand is that if any of these component pieces get close to being fully valued, it doesn't make any sense to hold on to them. Sell them. But people fail to see it because they go, I'm not actually holding it. Well, you are, but it's just embedded in the position. And so that just never crosses their mind that they could actually be selling this, collecting the profits out of there, reducing their costs, and reducing the risk. And so what I'm about to show you here becomes one of the most valuable risk management techniques you can use. So let's take a look at a simple example. Let's say that we're looking at a series of stock prices here. We could buy shares at 100 and sell them at 105. That's one possibility. But I could also see that as a series of steps. I could instead buy the shares for 100 and sell them for 101. And then I could buy them back at 101, sell at 102. Buy back at 102, sell at 103. Same thing up here at 104 and then at 105. It's a series of steps. So what's different? Now, of course, not counting commissions, but just mathematically speaking, what's different here? One trade of $5 or 5 trades of $1? They're exactly the same thing. But because people don't see it as a series of steps, it's easy to overlook. So let's look at a more complicated example. Let's say these are some strikes that we have, and maybe I'm using a vertical spread. So I'm long the 100 call and I'm short the 110. This is actually what I'm holding in my account. However, how else could I view this trade? Well, I could see it as being long the 100 and short the 105. And then I could see it as being long the 105 and then short the 110. So notice that if I do that, the two trades right here at the 105 strike are -1 and +1. So they vanish. They actually wouldn't be in the account. And I'm just left with this long 100 and the short 110, exactly what I had initially. So this shows that I can look at this position as being long the 100-105 vertical spread and also being long the 105-110, even though I'm not really long those positions. They are embedded in that 100-110 vertical spread. And so if any of these pieces in here becomes fully valued, doesn't make sense to hold on to them, let's sell them off. So let's jump over to an Excel spreadsheet and take a look at a specific example. All right, so here's our Excel spreadsheet, and let me just explain some of these cells here. It's actually quite easy. This first block up here, I'm just looking at a stock price of 105, and we have 30 days to expiration. I'm looking at 3 different strikes, the 100, 105, and 110, and these are the prices. These were actually pulled from a pricing model, but let's just say these are the prices that we're seeing in the actual market. Now, if I buy the 100-105 call spread, it would cost me $283, and that's just spending $771 and then receiving $488 for the 105. I could also choose to do the 100-110 spread for $484. I'm spending $771 and then I'm receiving $287 from selling this 110 call, and that gives me a net cost of $484. So these are 2 different choices that I might be looking at. If I take the 100-105 spread, my maximum gain is $217, and that's because the spread could be worth a maximum of $5. That's just the difference in those strikes. So if I paid $283, what's left over? $217. The same idea holds here for the 100-110, But this is a $10 difference, so it could be worth a maximum of 10. If I spent 484, the most I could make would be 516. So let's just say for right now, this is the spread that I have chosen. And I've purchased this, I've put it in my account. Now, we fast forward to where we have 15 days till expiration. Let's say the stock has jumped up to 112, maybe volatility's fallen a little bit, but this is what happens in the market. Things change. And as things change, I should go back and reevaluate these positions and these components to it, these smaller pieces, and see if I can get rid of some at some profits. So now here are the same strikes that we saw up above, but with the new prices. My 100 call is worth $12.15, 105 call is $7.60, the 110 call is $3.86. So right now the 100-105 vertical spread is worth $4.55. That's just spending $12.15 for the 100 and receiving $7.60 for the 105. So I could close this spread right now for $4.55. On the other hand, the 100-110 spread is worth $8.29, and that's because I could receive $12.15 from selling the 100 call, and I would have to spend $3.86 to close out this 110, and that's a net of $8.29. So regardless of which of these two that I chose, how did I fare? Well, if we took the 100-105 spread, my profit would be $1.72. And that's because I spent $2.83. I could close it for $4.55. I would make $1.72. If I took the 100-110 spread for $4.84, I could close it for $8.29, and I could pick up a profit of $3.45. However, as I just showed, even though I'm holding the 100-110 vertical spread, right, this is one that I assume that I bought, I could view it as if I have the 100-105 long and I have the 105-110 long. So again, I don't really have those in my account, but I could see it as if I did. Those are the component parts. So let's say that I decided to sell off the 100-105 spread. Why might I do this? Well, take a look. It's trading for $4.55. The most it could ever be worth is $5. It's basically fully valued. Why do I want to continue holding it when it can't do me much more good to the upside, but it could certainly harm by $4.55? It's not good risk management. There's not a lot of profit left in it. There's a lot of profit left in the 100-110 spread in total, but this component part right here is fully valued. So let's sell that off. I'm going to close the spread here. Again, even though it's not in my account, I'm going to sell the 100-105 vertical spread. And what does that leave me with, as I just showed on the previous slide? That leaves me with the 105-110. So look at what I've done. If I sell that spread for $4.55, I initially spent $4.84. That gives me a new cost basis of 29 cents. Now granted, I don't own the 100-110 spread anymore. I own the 105-110 for an effective cost of 29 cents. This is the worst that it can hurt now. Most I can lose. However, I could possibly close this spread for a total of 5, right? That's the most that spread could ever be worth, which means I might make $4.71. Well, had I held this spread initially by itself, I could have made $5.16. But now I can only make $4.71. I've reduced my profit by 45 cents. Where's this missing 45 cents coming from? It's coming from right here. The most this spread could ever be worth is 5. If I spin it out of the account for $4.55, I can no longer collect that extra 45 cents. But in my view, big deal. I didn't want it anyway. I wouldn't initiate this position at a cost of $4.55. I don't even want it in the account. It really can only do harm and no good. So yeah, I'm giving up those 45 pennies right there in exchange for tremendous risk management. That's why I have reduced my profit by 45 cents. I could look at this another way. Going back to this date that we saw over here, what if we had initiated the 105-110 as a brand new trade? I would have spent $7.60 and received $3.86 for a cost of $3.74. The most it could be worth is 5, so my maximum gain is $1.26. That's assuming I bought this spread right now. But notice by doing this little hedge down here, Had I closed this position, I would have received only 345 back on this date for my spread. But because I've done this hedge, I can now possibly receive 471. That's an increase of $1.26. Where is it coming from? Because mathematically I have purchased the 105-110 spread. So even though I didn't buy it originally back here, when I did it to spin it out of the account, it was still a purchase. And it's no longer in the account, so it can no longer harm me. And again, I wanted it out because it wasn't going to do me any good. And yet I'm still holding this $5 spread now at a cost of 29 cents that might be worth 5. And if I'm wrong, the most I can lose now is only 29 cents. Instead of back on this date, it could have been 455. So I hope this helps you to see the importance of understanding the more complicated positions as a series of smaller positions. And if any of those smaller positions become fully valued, get them out of the account. It's good risk management, and they weren't going to help you anyway. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.